So I'm here with Ziel Feldman, who's the founder and CEO of HFZ Capital Group, one of the most active residential developers in the city, and has been for the last, I would say, 3 decades almost?
Too long.
A little bit too long. So one of the things that I remember seeing when we had Steve Witkoff in here a couple months ago, and he started off as a lawyer. And he said, I always wanted to be one of those guys. You know, they were coming in, those swashbuckling guys. I always wanted to be one of them. We chatted with Lou Ceruzzi recently before he passed. He said that I was a lawyer too, and I kept noticing the difference in the paycheck between my paycheck and the people I represented. You also went to law school. How did you decide to be this? Was it for any of these reasons?
I was an attorney for 6 years in a very active real estate law firm.
Which one was that?
It's called Fleming, Westreich, Nussbaum, Glasson and Weiss. But in 1984 is when I broke into the legal business. Graduated, I think, in 83, 84. That was a very frenetic time in real estate. So it was one of the most busy times in my entire career. People were coming out of the oil crisis, 82, 83, and market started taking off. And we did see our clients making a lot of money. We thought it was due to our efforts and our brains, a lot of transactional work. And we thought we were so smart, we started buying real estate with clients in 1987 as the market effectively collapsed after Black Monday and the Tax Reform Act of 86. So the market peaked and collapsed in March of 88. So we spent the next couple of years working out the brilliant deals that we did as lawyers for real estate, and then formed a real estate company with a guy named Kevin Maloney in 1991.
So you were one of the original partners at PMG.
PMG was myself, Kevin, and 2 other fellows.
One of those fellows eventually, it was Gary Barnett as well.
Gary Barnett, myself, Kevin, and there were 2 other guys who left, fairly early.
I know one of the buildings that you bought was the Belnord, and this is actually, you've bought it again. This is your second crack at
a little more money this time.
Well, a little bit more money. What attracted you to that building back then, and why do you think it's worth, how many multiples now? I think you're aiming for a $1.3 billion sellout on the condos. So tell me about the first time and the second time.
Well, the Belnord is among the nicest residential buildings ever built in the world. And at the time it was built in 1903, it was the largest residential structure in the world. And at the time, the Belnord, you had the Apthorpe, you had, I think, Graham Court up in Harlem, 1 or 2 other buildings maybe on the east side. But at the time, townhouse living in a vertical building was something that everybody wanted to do. So the ability to feel like you're living in your own house, but have all the amenities and security of a big building was how this was built. So every apartment faces the park. There's only 50 feet. There's 50 feet in depth in every unit. So it was really.
But it was a rental back in the day.
It was a rental. When we bought it, it was a rental. It had a sordid history of litigation with the prior owner. The prior owner believed property rights were a constitutional right, and the city of New York had a different view of it at the time. Down
in Chelsea, in West Chelsea, you were going for, when you bought this project, you paid $870 million, I believe, north of $1,000 a foot. And at the time when I chatted with you, I called the deal ballsy, and you bristled at that. You're like, why is this deal ballsy? Looking at the buyer market now, looking at what you're looking to ask, I believe it's between $35,000 and $4,000 a foot. At least that was the last number you talked about. You still think you're in the right position, that project?
Well, actually, I think now we're in a better position than I thought about even then.
How so?
By the way, at the same time, we're now offering on the market 2 square blocks, 80, a bunch of blocks apart and 100 years apart. So you think about offering a square block Belnord, turn-of-the-century building as reinterpreted to modern times, and then building a modern contemporary building down in Meatpacking or West Chelsea. So it's really a sign of the Upper East Side, the Upper West Side, this pre-war stock that everybody wants. And as you go downtown, everybody would like, the glistening new condos, the beautiful architecture. So 2 square blocks being offered within 6 months of each other to 2 different buyers, 2 world-renowned architects, and that's something that's actually, I find very exciting.
I'm finding, when you paid $870 million, even for someone who'd been in the business for a long time, that did it come with any reservations? Did that come with some anxiety?
Well, the number 870 is a large number. That's why you're asking the question.
Sure.
But the reality is, on a price per foot basis,
You paid $1,100 a foot.
We paid less than what other less comparable land was trading for at the time. Included in that $1,000 or so a foot, we had tax credits equal to $30 to $60 million. We also had a property that was fully clean, fully ready, shovel ready to go, whereas we built a project on 19th Street a couple blocks away where we're in the ground for 10 months. So when you take into account what you are being delivered and how much money the prior owner spent in order to get the property to where it is, we look at it as a very good deal that we bought.
And then you were trying to get money for this project for a long time. Children's Investment Fund eventually came through with the $1.25 billion loan, one of the largest of the cycle. I wonder what traditional banks were thinking about that deal when you presented it to them.
So I will tell you, you say we were trying to get money for a long time. That's actually not correct.
Okay.
We had a 2-year loan, which we closed on to buy the property.
Right.
And we refinanced it on the last day.
Am I thinking of SL
maturity.
Green and someone else?
You had J.P. Morgan leading the group, and you had some mezzanine lenders as well. But J.P. Morgan led the group. And just exactly according to our plan, we refinanced the property on the maturity of our bridge loan. In fact, we did not go to market to look for construction financing. We were about to. We, in fact, hired 2 separate companies, even paid them for marketing, which they did not do. Had several offers from our existing lender and others without going to market.
So they wanted to go ahead and bankroll the project.
And that particular company was very anxious, and made us a deal. We shook hands, and the deal got done very quickly.
But is it TCI in every case is different, but Children's is known for high yield. Like they're known for making pricier loans than a traditional bank.
What they're known for is being involved with the most iconic buildings in New York that have been built in the last 5 years. That's what they're known for.
So did you try to go to more banks besides the ones you talked about? Did you try
We felt that dealing with one lender, because of the size, other lenders would have had to do a club deal of sorts. So it was a little less complicated, and they made us an offer we couldn't refuse.
Right. So you got the money for this project. You've got 6 census coming in. Halves come in to, I think, take 50% of the hotel portion. What does that do for buyers? Is there any benefit from that hotel deal? I know it's a 5-star deal with the top Asian brand. Does that do anything for the buyers? Is that a sweetener for them in any way?
Absolutely. By the way, 6 Sense is not an Asian brand. They have hotels around the world. Neil Jacobs is a CEO, former CEO of 4 Seasons. They're in Portugal. They're in Cachaval. So they're really a company that's made a decision to expand their what was known more as spas and some hotels to a lot of hotels. We're talking to them about several others.
Okay.
Like 4 Seasons, like the Mandarin, the success, if executed properly, you definitely create a driver and potential greater velocity and higher price per foot if you can execute with the right brand for your apartments.
Are there amenities that the buyers can take advantage of or anything like that?
Absolutely. Like, the 4 Seasons downtown that Larry Silverstein built got pricing, I believe, far in excess of what the otherwise would have gotten without that brand. So the right brand executed properly has so far proven to be a good driver for value.
Did you, when people were taking you as, oh, this is the guy who's going to get burnt this time, this is the guy who's, and there was a lot of this press, some from us, some from others, and people in the market as well. How do you react to that, or how do you, like, you've seen a few of these, and you've been called this before. What was your take?
Well, I've been in this business as a lawyer and a developer since 1984. Okay, so I've been living through cycles.
Yeah.
I pride myself in being a student of cycles. I've mentored young people like yourself about how to judge where the markets, or guess where the markets are going. To me, you sell real estate when you're not at the top of the market, but somewhere in the middle, and you buy it not at the bottom, but somewhere off the bottom. So if you're somewhere in the middle, you'll always do very well. So I've had too many years of experience to have any negative reactions by people to impact me in any way whatsoever. I mean, it meant nothing to me. It was actually kind of humorous at the time. I think it was more a skepticism of whether or not you can get a construction loan that size within that part of the cycle.
What are other people doing? So if they're
Because
not
I've never heard
able
of
to get
anybody
that?
say this wasn't the best piece of land in the city of New York. So everybody thought this was the best location to be building. Everything is moving west.
You must have heard overpriced, because we heard it from several people. Ziel's getting burned. Ziel's going to get fucked
Over
on
my
this property.
career,
Ziel, this is the final one. This, well, for you, this was the one that people would talk about. For Gary, it's Central Park Tower. So there were a lot of the big developers. People think this is the piece that's going to topple the empire.
You know, I heard press also when I was one of the only ones buying in 2009. The many buildings that we bought when nobody else was buying, and they were hunkering under their pillows, wondering when the world was going to end. So again, a lot of what we do requires a lot of luck, but also education. An educated decision on where to buy, when to buy. Study your demographics. Study global politics. You have to study a lot of different things.
Right. So everyone talks about supply/oversupply. Everyone talks about dirt. What are the factors that people should be looking at in this market that they might not be? Are there factors like that in the New York residential market?
There are factors in making any kind of investment, in anything you do, whether you're a stock picker or whether you're, trading currencies or buying real estate. Frankly, real estate is greater than just New York. It's a global industry, and depending on where you're asking me, for advice, I would offer, supply and demand is what drives everything, and the ability to capitalize. You make or lose projects based on the buy and the execution. So if you've capitalized your property well and your project well, generally in the New York market, or certainly in Manhattan, the cycles have always returned values many times more than they were previously.
Right, but as an investor, as someone who wants to take on big properties, for the last few years, people have been counting on Chinese capital coming in. Everyone from Related to smaller developers has been looking for Chinese partners, to Gary Barnett with SMI. In the last few months, the government in China has really cracked down on Chinese capital outflows at the very highest level. If you look at what's happening with HNA, they're being scrutinized to a different degree. There's a few other companies, Anbang, the kings of 2015 and 2014, sort of the pariahs of 2017. Do you see that as a long-term detriment to this market? Or how are people getting around it?
No, not at all. I think some of the over-exuberance in this market is being driven by maybe over-exuberant capital, but there's absolutely no shortage of capital for dealers that underwrite properly. There's more capital than people know how to dispose of.
Okay.
So unlike previous cycles where there were issues, there's as we speak, liquidity is abundant. Interest rates are historic lows. The issue is how do you dispose of that capital?
Have sellers taken into account that the fact that the over-exuberant buyers are now not there any longer?
Everybody talks about the demise of Billionaires Row, and you had two or three sales of $70 million in Bill's building in 520 Park Avenue. You've got 432 Park has some great sales. We sold a penthouse, 2 apartments recently for over almost $40 million and over $10 million. So
whereabouts was that?
68th Street, an apartment we sold, and a penthouse we sold 68th Street about 6 months ago. So, and our product is moving everywhere that we're in the market for selling at the pricing which is appropriate. We try to appeal to be the lowest cost provider for the highest product available in the neighborhoods that we're in. So for instance, if I'm selling something on 8890 Lex, and my average price is $2,000 to $2,100 a foot, Park Avenue South needs to achieve $2,300 to $2,400 a foot. So that's a good place to be.
We talked about Chinese capital, and we were talking about the institutional capital, but let's talk about capital for projects coming through EB5. You've been a big user of EB5. What's your take on where the program is going? In 3 months, are we going to have another mini extension?
I can't imagine. Well, I can't imagine the program being eliminated. Okay, so that would be difficult to understand. It helps create jobs. It creates an immigration population that is hardworking and is investing money here. So I think my best guess is it continues along the way it has with some maybe more stringent rules on some of the abuses which are a tiny minority of what EB5 program has been here, and maybe the prices are somewhere between 750,000 and $1 million.